Welcome to the Deep Dive, where we take your stack of source material and pull out the essential intelligence and, well, the surprising insights.
And today we are really jumping into a big one.
We're doing a deep dive into regional banking consolidation, specifically the definitive merger agreement between OceanFirst Financial, that's ticker OCFC, and Flushing Financial, FFIC.
This deal is fascinating. It creates a major regional player, but it's not just a simple story of getting bigger. It's a blueprint for some highly aggressive financial engineering.
And it's coupled with a major external capital infusion, right?
Exactly. So our mission today is to unpack the mechanics for you, the strategic thinking behind it, and the really crucial regulatory context that just defines the execution risk here.
Okay, so let's start with the top line data. Let's just unpack the deal itself.
Sure. It's an all-stock transaction. OceanFirst is acquiring Flushing in a deal that's valued at, around $579 million?
So Flushing shareholders get 0.85 shares of OceanFirst for every share they hold.
Right, which is pretty standard. It's designed to give them about 30% ownership of the new combined company. But like you said, the real story isn't just in that stock swap.
No, and here's where it gets that market conviction. At the same time, OceanFirst announced they secured a fully committed $225 million strategic investment.
From Warburg Pincus, no less.
A huge private equity player. They're taking a 12% stake in the new company. That is a massive signal of external validation.
It's critical.
Yeah.
Because the scale they're chasing here is just enormous. Once this closes, and they're aiming for the second quarter of 2026, we're looking at a $23 billion bank.
In terms of assets, yeah.
$23 billion in assets, backed by $18 billion in deposits. And geographically, it's a huge push for density. 71 retail branches all under one roof, targeting those really high-value markets.
New Jersey, Long Island, the core New York City boroughs.
Exactly. Deposit-rich markets.
And to really get the audacity of this move, you have to look at OceanFirst's DNA. I mean, they have always used M&A to grow.
It's their primary accelerant. They've completed deals for, 7 different financial institutions just in that tri-state area since 2015.
It's just aggressive accumulation. You think back to 2018, the Sun Bancorp deal.
For 2020, with Two River Bancorp and Country Bank Holding Company, this merger with Flushing is just the latest and by far the largest in a long string of these consolidation plays.
But that M&A playbook hasn't always worked out perfectly for them.
No, not at all. We can't forget about the Partners Bancorp deal.
The $186 million agreement they had to terminate in November 2022. And the stated reason was, regulatory delays.
And that timeline becomes incredibly important when you connect the dots.
With the regulatory shadows, yeah.
Exactly. Because you have to think about what came next. In September 2024, OceanFirst agreed to pay over $15 million to settle Department of Justice allegations.
Allegations of redlining. In 3 big New Jersey counties, Middlesex, Monmouth, and Ocean, from 2018 to at least 2022.
Right. And this wasn't just a slap on the wrist.
No, it's a serious institutional commitment to fix systemic failures. And this scrutiny was foreshadowed. Back in November 2021, the OCC, the Office of the Comptroller of the Currency.
Right before the Partners deal fell apart.
Exactly. They downgraded the bank's Community Reinvestment Act rating, the CRA rating, from satisfactory all the way down to needs to improve.
And the real takeaway here isn't the fine. It's the mandatory operational overhead that comes with it.
What do you mean?
Well, OceanFirst is now required to invest at least $14 million in a loan subsidy fund. They have to spend $700,000 on outreach, hire a director of community lending. It's a lot.
And while the bank tried to pin some of it on that 2018 acquisition of Sun National Bank,
which had already gotten out of consumer lending,
the reality is this new combined entity is going to be operating under a severe regulatory microscope.
That's the perfect way to put it. The cost of that mandatory overhead, that compliance, that $14 million fund, it introduces a huge variable into their model, just as they're starting their most complex integration ever.
Okay, so that's a perfect segue. We've talked about the liabilities. Let's flip it and look at the financial assets they're promising. What are the financial engineers telling investors they can achieve to balance out this risk?
Well, the projections for 2027 are, they're genuinely ambitious. And they're built almost entirely on the idea of cost synergies.
The headline number is that estimated EPS accretion, right? Earnings per share. About 16%.
16% accretion.
Yeah.
And they're targeting profitability benchmarks that, they signal that management believes this creates a really high-performing regional bank.
So what would it be talking about?
They're aiming for a return on average tangible common equity, or ROTCE, of about 13%, and crucially, a return on average assets ROAA of 1%.
And that 1.000% ROAA is a key industry benchmark.
It is. It signals they think the merged bank is going to be incredibly efficient and profitable for its size.
They're also projecting a net interest margin NIM of about 3.2%. And while the deal does have some initial tangible book value dilution,
About 6%, yeah.
they expect to earn that back in around 3 years. Which, when you combine it with a projected internal rate of return of 24%, you can see why institutional investors would be excited.
And this is where we have to circle back to Warburg Pincus.
Right.
Their $225 million commitment isn't just passive money. It's a vote of confidence in those specific numbers. It's structured with 7-year warrants to buy 11.4 million shares.
And those warrants have a mandatory exercise trigger at $30 a share.
Which was a 52% premium at the time. It means Warburg Pincus is betting on massive, long-term value creation. They think that 16% synergy target is real.
So strategically, it all comes down to geography then. This merger gives them instant density in those super attractive, wealthy, deposit-rich markets.
Long Island, Suffolk, and Nassau counties. And it deepens their reach into Queens, Brooklyn, and Manhattan.
The goal being to combine Flushing's, 95-plus-year-old branch network?
With OceanFirst's relationship-driven business model and their wider product suite. It's about plugging OCFC's services into FFIC's customer base.
But, and this is a big but, OCFC is not building this empire in a vacuum.
Not at all. We have to look at the competition.
Dime Community Bank Shares, DCIM, a huge local peer, and they are actively positioning themselves to capitalize on the exact kind of disruption a merger like this creates.
And the data shows DCIM is the incumbent funding machine in this area. They have the largest market share in Greater Long Island. That's Kings, Queens, Nassau, and Suffolk, at 21.8% among banks under $20 billion.
They're not just big, they're structurally better funded.
Absolutely. The key metric is their deposit structure. Dime has a best-in-class 31% of their deposits in non-interest-bearing demand deposit accounts, DDA.
Which is basically free money for the bank.
Essentially, yes. The local peer median is just 20%. So this results in Dime having a much lower cost of total deposits. We're talking 2.09% versus a peer median of 2.57%.
So to put it simply, OCFC is trying to build a better network on Dime's home turf right as Dime is getting more aggressive.
Exactly. Dime is launching new commercial verticals, expanding into Westchester and New Jersey. They are actively scooping up market share from banks that look unstable.
Which brings us right to the integration hurdle. This is the hidden value driver or, the hidden value destroyer in any bank deal.
And we know the technology synergies, they make up a massive 40% to 60% of the overall cost synergy target.
So that 16% EPS accretion target, it hinges almost entirely on merging two complex tech stacks perfectly.
If you fail on the tech integration, you fail on the deal's core promise. Simple as that.
And the first step is just establishing an integrated business strategy, defining product migration, customer segmentation, and given their recent regulatory trouble, that part is critical.
It's task zero. If they disrupt their customer base, you know the regulators will be watching.
Then comes the tech integration strategy itself. Do they do forward integration, where Flushing moves to OceanFirst's system?
Or reverse, where they use Flushing's tech? Or maybe a best-of-breed approach. Every choice has huge cost and risk implications.
And finally, the data migration. The risky, fast, big bang approach or the slower, safer, phased approach.
The pressure is immense. The OCC has already flagged them on CRA compliance. Integrating these systems without causing a massive disruption to community lending and customer service is just non-negotiable.
If they don't flawlessly get those 40 to 60% tech synergies.
That 16% EPS accretion target becomes, well, pure fantasy.
Okay, before we wrap this up, let's put on our analyst hats for our This Is Not Financial Advice's segment. We're looking for an outrageous but plausible trade idea here.
All right, let's look at the setup first. OceanFirst is already a highly volatile stock. It has a beta of 1.54.
Which means it moves 54% more violently than the general market.
Right, and it's carrying high leverage, a debt-to-equity ratio of 1.15. This merger is, at its heart, an aggressive financial engineering play.
Designed for scale and efficiency.
So here's the pitch. You go long the combined OCFC-FFEC entity. You bet entirely on the deal as catalyst thesis.
And you ignore the projected 3-year earn-back period for the tangible book value dilution.
You ignore it completely because that time frame is irrelevant to this trade. The trade assumes the merger itself makes this new $23 billion entity an immediate prime target for a much bigger bank.
A national or a super regional player.
Exactly. You're betting on M&A acceleration in 2025 and 2026. This newly created, scaled-up consolidated deposit franchise in the New Jersey and New York market is exactly the kind of clean asset a big suitor wants.
So you're assuming a much larger bank will pay a massive control premium on these newly merged assets long before that 2027 synergy target even hits.
That's the bet. And to back it up, you have built-in growth. Just loan repricing alone is projected to add another 40 to 50 basis points of net interest margin expansion through 2026 and 27.
That growth trajectory plus the instant scale makes it a must-have asset for the next round of mega bank consolidation.
The outrageous part is the timing. You get in now, you accept the volatility, you get the regulatory risk, and you assume that the 3-year synergy plan is just the final addition that attracts the ultimate buyer.
Who then pays up for the clean, scaled footprint they just created?
That's the trade.
Okay, so to recap the highlights for you. OceanFirst is buying Flushing Financial, a $579 million deal creating a $23 billion asset powerhouse.
They're targeting a massive 16% EPS accretion, and it's all endorsed by that big $225 million strategic investment from Warburg Pincus.
But the success hinges on seamless technology execution and hitting those really demanding 40 to 60% tech synergies.
But the biggest unknown, the biggest variable, is still the weight of that recent regulatory history.
Right. So ultimately, the question for investors isn't just about the technology. It's whether the cost of fixing OceanFirst's past sins, those millions in mandatory compliance and community commitments, will completely eat away at that 16% synergy promise they've banked their entire future on.
That is the central tension in this deal, and it's what you need to track as this bank consolidation continues to reshape the whole tri-state financial landscape.